Imagine an entirely parallel $2 trillion banking system.
Yeah, just operating right under our noses.
Right. No tellers, no ATMs, and for the most part, it completely escapes the daily scrutiny of the public stock market.
Totally invisible to the average person.
Exactly. For a decade, it was, the ultimate VIP club for institutional money and the ultra-wealthy. But this morning, the exit doors to that club started locking from the inside.
It is getting incredibly tense out there.
It really is. So today, we are diving into the sudden, terrifying panic surrounding two words that Wall Street absolutely cannot stop whispering about right now: private credit.
I mean, it is the unavoidable topic of the year. You seriously cannot walk onto a trading desk or talk to a wealth manager or sit in a regulatory briefing right now without this dominating the conversation. The whole temperature in the room has just completely changed.
Yeah, and the central question we're trying to answer today for you, the listener, is whether this is the first domino of a broader financial collapse, or, if we are just looking at a maturing market having some very loud, very public growing pains.
Right. And to figure that out, we really need to demystify private credit from the absolute ground up.
We do. We're going to look at what it actually is mechanically,
Yeah.
the history of where it came from, the specific stories driving this current panic, and ultimately how this all unwinds.
And to pull this apart, we are working through a massive stack of recent market analysis. We're pulling heavily from official data provided by the Financial Stability Oversight Council, the Federal Reserve, the International Monetary Fund, and the Bank for International Settlements.
Heavy hitters. And we're also pairing those institutional policy reports with some very sharp, very recent investigative reporting from Reuters, the Wall Street Journal, and Barron's.
It's a lot of material to get through.
It is. But before we get into the actual mechanics of the market, I want to set a quick ground rule here for you. If you read the news, you know there is a highly charged political debate right now over financial regulation.
Oh, absolutely. It gets very heated.
Right. Some people view private credit as this socially useful tool that saved the economy when traditional banks retreated, and then others view it as a highly dangerous shadow banking system operating in the dark.
And I mean, that debate is entirely valid in the halls of Congress, but here we have to separate the mechanics from the politics.
Exactly that. For the purpose of this deep dive, we are remaining entirely impartial. We are not taking any political sides. We aren't endorsing one regulatory worldview over another.
No.
Our only goal is to objectively break down the facts, the data, and the actual financial plumbing from the material we have, so you can understand what is actually happening under the surface of the economy.
Because honestly, the pure mechanics of how the system was built and how it's currently cracking, they're fascinating enough without needing to put a political spin on them.
They really are. So let's unpack this. To understand the current panic, we actually have to start by completely unlearning what we think we know about this asset class.
Yeah, the definitions get really muddy.
They do. When most people hear private credit, they just think private loans.
Yeah.
And that sounds incredibly simple. It sounds like, me borrowing $20 from you instead of going to a bank.
Right.
But looking at the definitions from the Financial Stability Oversight Council, that is the single biggest misconception driving the confusion right now.
It is a massive oversimplification. I mean, if you only think of private credit as a category of loans, you are missing the entire point of why the global financial system is stressed out right now.
What is it then?
Private credit is fundamentally a different market structure. It's an alternative architecture for originating, holding, and valuing corporate risk. And it exists completely outside the traditional public bond markets and outside traditional bank balance sheets.
Okay, I want to make this tangible for the listener. Let's say I'm a mid-sized company. I run a regional chain of 50 dental clinics across the Midwest.
Okay, good example.
And I want to buy another 50 clinics, and I need $100 million to do it. Historically, what were my options, and how does this alternative architecture change the game?
Well, historically, a company of that size really had two main options. You could go to a syndicate of traditional banks, but banks are heavily regulated. They require strict collateral. And, after 2008, they became much more hesitant to make large, risky loans to middle market companies.
Right. And the second option?
Your second option was the public bond market.
And the public bond market is an absolute beast. I mean, if I want to issue public bonds, I have to hire investment bankers, file massive disclosures with the SEC, get graded by rating agencies like Moody's or S&P.
Yep, it's a whole circus.
And then I have to go on a roadshow. I'm flying from city to city, pitching mutual fund managers, begging them to buy pieces of my debt. And I am entirely at the mercy of whatever mood the public markets are in that week.
Exactly. If a macro headline spooks the market on a Tuesday, your debt becomes wildly expensive to issue on a Wednesday.
Right. So how does private credit bypass all of that?
That grueling public process is exactly what it avoids. The FSOC describes private credit as institutionally funded vehicles that make loans directly to businesses. So instead of a roadshow, you, the owner of the dental clinics, you just sit in a room with one private lender or maybe a small club of 2 or 3 lenders.
Okay.
And you negotiate the terms bilaterally, completely behind closed doors.
It's like VIP service. Total discretion, incredible speed, and certainty of execution. I know exactly who is writing the check, and they know exactly what my business needs.
But the crucial defining characteristic of this architecture isn't just how the loan is made, it's how the loan is held.
How do you mean?
Well, these are typically structured through closed-end funds, business development companies, which the industry calls BDCs or interval funds. And the core premise is that these loans are held to maturity.
Meaning, the fund makes the $100 million loan to my dental business, and they just sit on it.
They just sit on it.
They collect the interest payments every quarter until the loan comes due in 5 or 7 years. They aren't actively trading pieces of my loan back and forth on a secondary market every single day, the way public bonds are traded.
And that held-to-maturity structure changes absolutely everything. I mean, it changes the level of public disclosure required, it changes how the asset is priced, and most importantly, for the stress we are seeing right now, it changes how financial trouble becomes visible to the outside world.
Yeah, let's talk about the sheer size of this, because we are not talking about a boutique, niche operation anymore. The scale outlined in these policy reports is staggering.
It's huge.
The FSOC notes that North American private credit fund assets hit roughly $1.1 trillion at the end of 2024. That is up from $565 billion in just 2019. It literally doubled in 5 years.
Unprecedented growth.
And out of that $1.1 trillion, there is about $305 billion in what the industry calls dry powder.
Right, and dry powder is simply committed capital from investors that is just sitting there waiting to be deployed into new loans. It represents immense pent-up demand.
Wow.
And that $1.1 trillion is just the baseline fund assets. The FSOC also points out that BDCs grew their assets from $123 billion in 2019 to $438 billion in 2024.
And if you look at the broader global market estimates that Reuters is using to track the current stress, they frame the entire private credit industry at around $2 trillion. $2 trillion. There's a completely parallel banking system.
It really is.
So I understand why the borrowers love it. They get speed, customization, and they avoid the public roadshow. But why did investors pour $2 trillion into this? What was the pitch to the pension funds and the university endowments?
The pitch was tailored perfectly to the macroeconomic environment of the last decade. For years, we lived in a world of essentially zero interest rates. Institutional investors, like, say, a state pension fund that has to pay out retirement benefits for the next 50 years, they were absolutely starved for yield.
Right. Traditional government bonds were paying next to nothing.
Exactly. Private credit stepped in and offered much higher yields.
And crucially, these were floating rate loans, right?
Yes. Most private credit loans are floating rate. That means the interest rate the borrower pays is tied to a benchmark rate. If the central bank raises interest rates, the interest the borrower has to pay goes up. So the investor feels protected against inflation and rate hikes.
But, I mean, higher yield usually means higher risk, and higher risk usually means a bumpy ride for the investor's portfolio.
And this is where the genius or, the danger of the private credit structure really shines. They offered high returns with what appeared to be vastly lower volatility.
Because the loans aren't publicly traded. Let's think about this visually for a second. If I hold a public bond and the market panics on a Tuesday, the price of my bond drops on my screen. I see the volatility. I feel the pain immediately.
You see it in real time.
Right. But with a private credit fund, the assets aren't trading. I have this visual in my head of a duck gliding across a pond. If you look at the surface of the pond, the duck is moving so smoothly, not a single ripple, perfectly calm. That is what the investors see on their quarterly statements from the private credit fund, a nice, smooth, stable return curve.
But underwater, the duck's feet are paddling furiously.
Yes, that underwater paddling is all the mechanics happening behind closed doors. It's the private loan modifications, the quiet maturity extensions, the internal valuations negotiated in boardrooms. If my dental clinic hits a rough patch and can't make the interest payment, the public market would panic and crash the bond price. But the private credit lender just sits down with me, restructures the loan, adds the missed interest to the principal, and reports to their investors that everything is fine. It is completely hidden from the daily, chaotic panic pricing of the public markets.
The industry marketed this as less visible volatility. It became the ultimate selling point. But as the Bank for International Settlements and the FSOC both warn in their reports, that stability might just be a mirage.
Why is that?
Because these loans don't trade, and because comparable market prices are incredibly sparse, the reported value of the loan usually reflects slower price discovery rather than actual economic
Oh,
stability.
yeah. It is incredibly easy to look stable when no one is allowed to check your math every day.
Exactly. That opacity can mask underlying risks for years. It hides the deterioration of the borrower's health until some obvious, unavoidable event forces the market to reprice the asset. In good times, that lag of public pricing looks like incredible resilience. But when the macroeconomic environment shifts, it suddenly looks like terrifying opacity.
Which is exactly why you, listening to this right now, need to care about the valuation mechanics of closed-end funds. At $2 trillion, this impacts corporate funding, it impacts the availability of credit for the broader economy, and it is deeply tied into the private wealth of everyday people.
It touches everything.
But to understand how this duck got so massive and why it's suddenly thrashing in the water, we have to look at the historical forces that built this system. A $2 trillion parallel market doesn't just appear out of thin air.
No, it was a structural response to the aftermath of the 2008 global financial crisis.
The popular narrative we always hear on financial television is pretty simple. Regulators cracked down on the big banks after the 2008 crash, pushed them out of risky lending, and private credit just stepped into the vacuum. But looking at the sources, that narrative seems wildly incomplete. It wasn't just regulatory arbitrage, was it?
The idea that regulators just banished banks and private funds took over is a very convenient myth, but the reality is a confluence of several massive forces colliding simultaneously.
Okay, what's the first one?
The first force, undeniably, was bank retrenchment. Post-crisis capital regulations did make certain types of middle market and leveraged lending much less attractive for traditional banks to hold on their own balance sheets. They had to hold more capital in reserve against risky loans, which hurt their profitability.
But the banks didn't just walk away from the profits, did they?
No, and there's a fascinating paper published by the Federal Reserve in May 2025 that pushes back hard on the pure regulatory arbitrage story. The Fed researchers found that banks often find it more profitable to lend indirectly to these risky borrowers through private credit vehicles rather than holding the loans directly.
So they didn't leave the game, they just changed their position on the board.
Exactly. They became the financiers of the private credit funds.
We are going to dig deeply into that hidden web of bank financing in a few minutes, because that is a massive part of the current panic. So, force one is banks shifting their stance. Force two we already touched on. The zero interest rate environment starving institutions of yield. What was the third force that accelerated this?
The explosive expansion of private equity. Over the last decade, private equity firms bought up thousands of companies. These sponsor-backed deals became the natural habitat for private credit.
Walk me through the mechanics of that relationship. Why do private equity firms prefer private credit over traditional banks?
Let's go back to your dental clinic example. Imagine a massive private equity firm buys your 50 clinics. Their goal is to acquire 50 more clinics over the next 3 years, merge them all together, and sell the whole package at a massive profit.
Okay.
To do that, they need a lender who can move incredibly fast, offer absolute certainty of financing, and be highly flexible if the business needs to pivot. Traditional banks are slow, conservative, and constrained by regulation. Private credit funds are aggressive, fast, and entirely unconstrained.
Ah, so it's a reinforcing loop. The private credit lenders love lending to private equity-owned businesses because they know there is a giant, sophisticated pool of money backing the company. If the dental clinic gets into trouble, the private equity sponsor might inject more cash to save their investment. The bigger private equity got, the bigger private credit got.
Which leads us to the fourth and perhaps the most psychological force behind this massive growth. Over the last decade, there developed this widespread, deeply held belief that private governance was inherently superior to public markets.
Wait, hold on. Let me make sure I'm grasping the psychology here. Investors essentially trusted these funds more because they lacked public scrutiny. They assumed that avoiding public disclosure somehow meant the managers had better, tighter control over the companies they were lending to.
Yes. And structurally, I mean, there is some truth to it. Private lenders do have tighter control rights. They have a direct line to the CEO and the private equity sponsor in a way that thousands of dispersed public bondholders do not.
I guess that makes sense.
Right. If a company breaches a covenant in a public bond, it can trigger a messy public default. If a company breaches a covenant in a private credit loan, the lender and the sponsor just sit in a conference room over the weekend, renegotiate the terms, and quietly move on.
But isn't that a massive vulnerability? If you rely entirely on trust instead of public verifiable data, you're opening the door to massive blind spots. You become entirely dependent on the management's own internal formulas for valuing the assets.
It is the ultimate double-edged sword. That immense trust allowed the industry to scale from a boutique lending operation into an institutionalized juggernaut. But as it scaled based on that trust, it imported terrible new structural weaknesses.
Right.
And as we were about to see, it exposed the entire system to the very human emotion of panic. The historical trust in smooth, invisible valuations was the foundation of the boom. The sudden evaporation of that trust is the core of today's crisis.
Which brings us to the present moment, the panic of 2026. The sources make it very clear that the stress we are seeing right now is not one single catastrophic event like Lehman Brothers collapsing overnight. It is a cluster of intersecting narratives. The market is simultaneously testing the three core promises of private credit: stable income, limited volatility, and manager control.
And right now, the architecture is failing the test.
If valuation is the psychological trigger for this panic, let's start there. The illusion of stability is breaking because the broader market is actively rejecting the internal math these funds are using.
We have hard public numbers on this. As we noted, some private credit is held in business development companies, or BDCs. BDCs were actually created by Congress back in the 1980s to encourage lending to small businesses. But today, they are massive vehicles for private credit. And crucially, unlike closed-end institutional funds, many BDCs are publicly traded on the stock exchange.
So they offer a rare window into what the public market actually thinks these private loans are worth.
Exactly. Every quarter, the management of a BDC puts out a report stating their net asset value, or NAV. This is management saying, we looked at all our loans, we ran our internal models, and we believe our portfolio is worth exactly this much. But Reuters reported on March 12, 2026, that these public BDCs are trading at an average of 78 cents on the dollar compared to their reported NAV.
Let's just pause and do the math on that. That means the fund managers are publishing a glossy report saying our loans are worth $1 billion. And the public stock market is looking at that report, looking at the macroeconomic environment and saying, we absolutely do not believe you. We think your portfolio is only worth $780 million.
Yep.
That is a 22% haircut based purely on skepticism. And just a year ago, in early 2025, these were trading at par 100 cents on the dollar.
It is a staggering collapse in confidence. And when you look at the specific firms Reuters highlighted, the gaps are even more alarming. FSKKR Capital was trading at 51 cents on the dollar, Prospect Capital at 44 cents, Blue Owl Technology Finance at 68 cents. Even Ares, which is the largest BDC in the space with roughly $31 billion in assets, was trading at a discount at 94 cents.
Wait, 44 cents on the dollar? If a fund is trading at 44 cents, the market is essentially declaring that more than half of the value the managers claim to hold is pure fiction. How does a valuation disconnect that massive actually happen mechanically?
It comes down to how private assets are marked to market. In public markets, a bond's price updates every second based on actual trades. In private credit, there is no secondary market trading. So the valuation committee at the fund meets every quarter. They look at the borrower's revenue, they look at interest coverage ratios, and they use subjective models to estimate the value. But human nature dictates that managers are extremely reluctant to mark down their own assets unless they are absolutely forced to, because marking down assets hurts their track record and their ability to raise new funds.
So the managers are paddling the duck's feet, pretending everything is fine, but the public market is looking at the high interest rates, looking at the struggling middle market companies, and saying, your models are stale. Show us the real numbers.
The market is demanding price discovery, which is the exact mechanism private credit was engineered to avoid. Private credit grew because it offered an escape from daily mark-to-market volatility. But when the economic landscape changes, stressed investors suddenly want public market-style proof. And when liquid claims on illiquid portfolios trade far below their stated net asset value, it signals a massive breakdown in trust.
But if I'm a public market investor and I see that 22% haircut, I can just hit a button on my brokerage app and sell my stock. I take the loss, but I get my cash out. What happens to the people who are trapped inside the unlisted funds? Because that valuation skepticism leads directly into the physical mechanism that actually breaks the system, liquidity.
Yes. This is where the structural risk truly jumps levels. Historically, private credit was funded by patient institutional capital. A state pension fund or sovereign wealth fund commits capital for 10 years. They physically cannot ask for their money back early. That completely eliminates run risk. You cannot have a run on the bank if the depositors are legally locked inside the vault.
But the industry didn't stay locked in the vault, did they? They got hungry for more capital.
They did. Over the last decade, the alternative asset managers aggressively pushed into the private wealth channel. They started selling private credit to affluent, everyday individuals, dentists, lawyers, small business owners. The BIS reports that the retail share of private credit assets under management went from virtually zero a decade ago to 13%, which equates to roughly $280 billion.
But wealthy individuals don't want to lock their money up for 10 years. So how did the industry convince them to buy in?
Through what are called semi-liquid funds. These funds take retail money and invest it in highly illiquid, long-term private loans. But to make the sale, they promised the retail investors that they could get their money back periodically, usually quarterly, up to a certain limit.
I am trying to visualize the mechanics of a semi-liquid fund. It's like building a massive, gorgeous skyscraper with an occupancy of 10,000 people. But legally, to save money, you only installed one single standard-sized revolving door at the bottom.
That's a great way to put it.
The building is perfectly stable as long as people leave one by one at the end of the day. But if the fire alarm gets pulled, the building doesn't collapse from structural failure. People get crushed at the door because the exit physics literally cannot accommodate the panic.
That is a phenomenal mechanical analogy. And that single revolving door is what the industry calls a gate. The fund managers set a rule. We will only allow 5% of the fund's total assets to be redeemed in any given quarter. If withdrawal requests exceed 5%, the gate drops and everyone else is trapped inside.
And the fire alarm is ringing right now.
Data is pouring in and it is brutal. Reuters reported on March 6th that BlackRock's $26 billion semi-liquid fund, HLEND, received $1.2 billion in withdrawal requests in the first quarter. That's about 9.3% of the fund's net asset value.
Wow.
But they only paid out $620 million. They hit their standard 5% gate and simply stopped paying.
So roughly half the people who wanted their cash were just told, no, you have to wait until next quarter, and hopefully you can squeeze through the revolving door then.
Correct. And it is happening across the board. Blackstone faced such heavy redemption demand in its $82 billion flagship fund that it actually upped its gate from 5% to 7%. But even more telling, Blackstone employees and the firm itself had to inject $400 million of their own money into the fund just so client requests could be met.
And that's crazy.
Morgan Stanley had to restrict redemptions after a fund hit 11% withdrawal requests. The Wall Street Journal reported that Cliffwater faced requests equal to 14% of its shares.
14%. That is a massive run on the fund. And if you are Blue Owl, another massive player, you had to take drastic measures to find the cash. Reuters reported that Blue Owl actually sold $1.4 billion of assets from 3 of its credit funds at 99.7% of par, just to redirect that liquidity to manage redemptions and pay down debt.
What this reveals is a fundamental structural mismatch in product design. Private loans are phenomenal assets for patient, locked-up institutional capital. They are terrible assets for retail investors who are sensitive to news headlines and expect smooth, quarterly exits. When you sell illiquid loans to headline-sensitive wealth clients, you import classic run risk into a system that has no quick way to liquidate its assets without taking massive losses.
So we have plunging confidence in the valuations, and we have wealthy retail investors storming the revolving door to get their money out. But what pulled the fire alarm in the first place? Why are they demanding their money back right now? That leads us into a fascinating collision between archaic financial plumbing and the bleeding edge of modern technology. The third narrative driving this panic is tech shocks and software risk.
This is the specific spark that ignited the valuation fears. For years, private credit absolutely loved lending to software companies, specifically software as a service or SaaS firms.
Walk me through the underwriting mechanics here. Why did a lender look at a software company and say, yes, this is the perfect place to put $100 million?
Because of the business model. SaaS firms are asset light. They don't have expensive factories or heavy machinery to maintain. They have extremely high gross margins. But most importantly, they are heavily reliant on recurring subscription revenue. If a business signs a 3-year contract for your human resources software, that is highly predictable, recurring cash flow. Because that revenue seems so bulletproof, private credit lenders underwrote these loans differently.
Oh, so.
A traditional bank lends against hard collateral. If you default, the bank seizes your real estate or your trucks. But a software company doesn't have physical assets. Its value is its code and its customer base. So private credit lenders underwrote the loans based on enterprise value and projected forward revenue. They were essentially lending against the assumption that 95% of the customers would renew their software subscriptions next year.
They aren't lending against the office chairs. They're lending against the stickiness of the software. And then generative AI enters the chat.
Exactly. Generative AI threatens the very core of the SaaS business model. It dramatically lowers the barrier to entry for coding. What happens if a startup uses AI to build a competing version of that HR software in 3 months and offers it for a tenth of the price?
The competitive mode evaporates. The pricing power collapses.
And suddenly, that safe, predictable, recurring revenue starts to shrink, customer churn increases. And because these private credit loans were underwritten based on massive multiples of that forward revenue, even a 10% drop in subscription renewals can trigger a cascade that threatens the loan's covenants.
I'm looking at the exposure data here, and it is immense. The BIS reported in 2025 that over 15% of all BDC loans went specifically to SaaS firms. They note that BDCs hold 1/5 of all U.S. direct loans. If 15% of that entire ecosystem is tied up in a sector whose fundamental business model is being actively disrupted by AI, that is a massive systemic vulnerability.
And we are seeing the big players react mechanically. Reuters reported that JP Morgan actually began marking down the value of certain loans tied to software. When a major bank marks down the collateral, it actively reduces the amount of leverage available for the private credit funds. And going back to that $1.4 billion asset sale Blue Owl just did to raise liquidity, Reuters noted a 13% concentration in software within those sold assets.
So AI isn't just a fun tech story about chatbots. It is actively revaluing the collateral inside these massive, opaque lending funds. If you are an engineer working at a mid-sized software company, or if your business relies on these types of loans, this esoteric financial mechanics issue is directly impacting your industry right now. It dictates whether your company can roll over its debt or if it has to start laying people off.
It connects the bleeding edge of technology directly to the plumbing of private finance.
But it gets even deeper and, frankly, a bit more concerning. Because the fourth narrative completely shatters the idea that private credit is some isolated alternative ecosystem operating safely away from the big regulated banks. This brings us to bank interconnections.
This is where the term shadow banking gets thoroughly dismantled. Private credit is fundamentally not separate from the traditional banking system. It is deeply structurally braided into it.
Braided. Because, as we mentioned earlier, the banks didn't just walk away after the 2008 regulations. They found a new way to profit. I want to understand the physical mechanics of how a bank funds a private credit vehicle. What are the actual instruments they use?
There are 2 main instruments: subscription lines and warehouse facilities. Let's start with subscription lines. When a private credit fund raises $1 billion from pension funds, they don't take all the cash on day one. They use capital calls to draw the money down when they actually find a loan to make.
Makes sense.
But coordinating capital calls takes time. So a massive bank provides a subscription line of credit to the fund. The fund uses the bank's money to make the loan instantly and then pays the bank back a few weeks later when the pension fund money arrives.
It's a bridge loan. And it boosts the fund's internal rate of return because they delay taking the investor's cash, making their math look better. Okay, what is a warehouse facility?
Think of a warehouse facility like a massive temporary corporate credit card provided by a bank. A private credit fund uses this credit line to quickly originate loans and store them in a warehouse on the bank's balance sheet until they gather enough loans to package them up and move them into a permanent fund structure.
So the traditional, highly regulated banks are providing the raw liquidity that powers the entire private credit assembly line.
Exactly. Federal Reserve data from May 2025 shows that bank credit lines provided to private credit vehicles rose 145% over the previous 5 years, hitting $95 billion, with about $56 billion of that actively utilized. The Wall Street Journal goes even further, reporting that major banks like Wells Fargo and JP Morgan have provided nearly $300 billion in loans to private credit platforms since 2016.
I'm not sure I buy the industry's defense that this makes the system safer. If the big regulated banks are providing hundreds of billions of dollars in funding to the private funds, so that those private funds can turn around and make the risky middle market loans that the banks were supposedly too heavily regulated to make themselves, isn't that just a giant systemic shell game? The risk hasn't left the banking system, it's just wearing a disguise.
The Boston Fed researchers politely refer to it as a symbiotic relationship. In good times, it is highly profitable for everyone. The banks get to finance the ecosystem, keeping the risky corporate loans technically off their balance sheets while still earning a steady return on the credit facilities. But in periods of stress, like right now, this interconnected web becomes a massive transmission mechanism for panic.
Mechanically, how does the panic transmit from the retail investor all the way to the big bank?
Follow the cash. A wealthy dentist gets spooked by AI headlines and asks for her money back from the semi-liquid fund. The fund hits its redemption gate, but it still has to pay out that 5%. To get the cash, the fund draws down its warehouse facility or its credit line with the big bank. Now the bank is looking at the fund's portfolio, realizing it is full of software loans that might be overvalued. The bank gets nervous and decides to cut the credit limit or demand more collateral.
And if the bank cuts the credit line, the assembly line stops. The private fund has no cash to meet redemptions, so they're forced to fire sale their assets into a panicked market. Selling assets at a massive discount tanks the valuation models across the entire industry, which triggers more retail panic, which triggers more bank tightening. It is a vicious, systemic doom loop.
Which naturally funnels up into an absolute crisis of confidence for the giants who built and run this system. And that brings us to the fifth narrative, the fall of the titans.
When we talk about private credit, we aren't just talking about abstract nameless funds. We are talking about the massive alternative asset managers, the masters of the universe. Firms like Apollo, Ares, Blackstone, KKR, Carlyle, and Blue Owl.
And the public markets are violently repricing these firms. According to Reuters Breaking Views on March 18th, the stocks of a dozen major U.S. and European private capital firms fell by an average of 32% over the last 6 months. A third of their market value wiped out.
And what's really striking in the data is the collapse of their valuation premium. These alternative asset managers used to trade at massive premiums compared to boring, traditional mutual fund managers. Wall Street absolutely loved them, but that premium has collapsed. They are now trading at roughly 14.3 times forward earnings compared to 13.1 times for traditional managers. That's only a 9% premium. Why did they command such a massive premium in the first place? What was the story they sold to the stock market?
To understand the premium, you have to understand how private credit fundamentally transformed the business models of these firms. Historically, a firm like KKR was known for private equity buyouts. They were episodic deal makers. They raised a fund, bought a company, spent 5 years fixing it up, sold it, and took a massive cut of the profits. Earnings were lumpy. You only got paid when you exited a deal.
But private credit changes the revenue model entirely.
Yes. Private credit turned them from episodic dealmakers into scaled financial intermediaries. With perpetual or semi-liquid private credit funds, they aren't waiting years for an exit to get paid. They are generating steady, massive, ongoing management fees just for holding the assets. This created what the industry called the platform thesis.
The platform thesis, meaning they aren't just a bunch of smart guys making risky bets anymore, they are infrastructure.
Exactly. The stock market rewarded them with massive valuations because they were seen as structurally superior platforms. They owned proprietary origination networks to source the loans, they had locked in institutional capital, and most importantly, they had built a massive, highly efficient pipeline directly into the wallets of wealthy retail investors. The market priced them as if they could scale their assets under management infinitely, forever.
And that infinite growth story is exactly what is burning to the ground right now. If the wealth channel dries up, if affluent retail investors get burned by these 5% withdrawal gates and swear they will never put another dollar into an illiquid fund, then the golden goose is dead. The current stock sell-off isn't just about a few bad software loans taking a markdown. It is a fundamental, existential reassessment of their entire growth engine.
The market is waking up from a decade-long trance. Investors are looking at these titans and realizing, wait a minute, if you can't raise retail money anymore, you might just be traditional asset managers, but with significantly worse liquidity, much more opaque pricing, and way higher fees. The moment that narrative shift happens, the multiple collapses.
It's fascinating because the stocks of all these major firms are moving down together in lockstep, even if their specific loan exposures are totally different. The market sees a common vulnerability in their underlying business model, a deep dependence on private wealth fundraising. and a reliance on the myth that private capital could avoid public market scrutiny forever.
So we have the titans bleeding in the stock market. We have BDCs trading at severe discounts. We have wealth funds slamming gates shut on retail investors. We have banks tightening credit lines.
The natural question for anyone listening right now, whether you are an engineer, a dentist, or a small business owner, is, does this stay contained to Wall Street, or does this crash Main Street? Are we looking down the barrel of the next great financial crisis?
To answer that, we have to trace the spillover channels. How does stress in an opaque, closed-end credit fund actually reach the broader real-world economy? The most direct and immediate channel is credit supply contraction.
Walk me through the mechanics of that contraction.
If private credit managers are suddenly dealing with retail redemptions, falling valuations, and nervous banks cutting their warehouse facilities, their psychology shifts from offense to defense. They stop making new loans. They hoard cash.
And if they stop lending, that mid-sized logistics company or that regional dental clinic can't get the cash they need to expand. Worse, they might not be able to roll over their existing debt just to keep the lights on.
And this hits the economy at a highly vulnerable moment. The macroeconomic data in our sources notes that U.S. GDP was already incredibly sluggish, growing at just 0.7% annualized in the fourth quarter of 2025. February 2026, payrolls were down 92,000, with unemployment ticking up to 4.4%. If a major $2 trillion source of corporate credit suddenly freezes up, companies instantly halt hiring, they cancel warehouse expansions, they start laying people off. That is how esoteric valuation models translate directly into human job losses.
That's the real-world credit impact. But there's another spillover channel mentioned in the sources that absolutely stopped me in my tracks.
Yeah.
The insurance exposure.
Yes. This is where the risk touches almost everyone.
The Wall Street Journal reported that U.S. life insurers increased their private credit exposure by 21% in 2025, adding $83 billion to reach a total of $482 billion in exposure. Wait, let me make sure I understand the gravity of this mechanic. Life insurers hold nearly $500 billion of private credit. Does that mean everyday people's life insurance policies, their retirement annuities, the safety net of the middle class, is secretly exposed to the internal valuation models of unlisted software companies?
Yes, it does. To understand why, you have to look at the mechanics of duration matching. Life insurers have massive long-term liabilities. If they sell a 30-year annuity, they know exactly how much they have to pay out over the next 3 decades. To fund those payouts, they need long-duration assets that yield a specific return, say 6 or 7%.
And standard government bonds weren't yielding 7%.
Exactly. Private credit was the perfect mathematical match for them on paper. It offered the required yield and the long duration. So the share of life insurance assets tied to private credit rose from 7% to 8%. Now, to be clear, an insurer doesn't have the same run risk as a retail semi-liquid fund. Policyholders don't all die or cash in their life insurance on the exact same day.
Right, the exit physics are different.
But it massively broadens the systemic footprint. If those private credit assets take severe markdowns because of AI disruption or economic slowdown, it damages the balance sheets of the massive institutions holding the safety net of the middle class.
Okay, so with bank warehouse lines, life insurers, and retail wealth all tangled up in this web, the immediate comparison everyone wants to make is to the banking crisis of a few years ago. Is this just 2023 all over again?
Our sources are very explicit on this point. There is a distinct family resemblance, but the actual plumbing of the crisis is completely different. It is not the same event.
How does the plumbing differ?
The 2023 banking crisis was fundamentally a problem of runnable liabilities. Banks had depositors who could, with a tap on their smartphones, pull their money out overnight. When confidence cracked, the money vanished instantly. Private credit, by contrast, uses closed-end capital or those gated semi-liquid funds we discussed. You physically cannot execute an overnight run on a private credit fund.
Because the revolving door is either locked or it only opens a tiny crack once a quarter.
Exactly. So the instability does not manifest as a spectacular overnight implosion on a Friday afternoon. It manifests as a slow, agonizing bleed over months and quarters. It looks like widening discounts to NAV. It looks like bank credit lines quietly tightening behind the scenes. It looks like a slow strangulation of new corporate lending.
But there is one very strong parallel to 2023, which is the terrifying nature of technological concentration.
Yes. In 2023, the technology concentration was in the depositor base, thousands of tech startups, all banking at the exact same regional institutions. When tech panicked, the deposits fled simultaneously. Today, the technology concentration is in the collateral. The massive percentage of loans extended to SaaS companies facing AI disruption. In both cases, concentrations that felt completely safe and highly profitable in a boom environment suddenly became systemic vulnerabilities the moment the macro narrative shifted.
So it's not a fast explosion, it's a slow burn. But if the real systemic risk is this slow burn leading to fire sales, which tanks collateral values across the board, which crushes credit availability for regular business as well, you can't have a crisis of that magnitude without the people in charge waking up. Which brings us to our final act, the rulemakers awaken.
And this is where the political economy of financial regulation takes center stage. For years, politicians and regulators operated with a massive regulatory gap regarding private credit, and frankly, they were relatively comfortable with it. Post-2008, the prevailing regulatory wisdom was that risk needed to be dispersed away from the big, systemically important banks. Private credit accomplished exactly that. It kept the economy moving, it funded middle market growth, and it did it largely out of the intense regulatory spotlight.
It was viewed as an evolutionary adaptation, not a systemic threat.
Right. But now, as the FSOC and the Financial Stability Board wave massive red flags about stale valuations, opaque ratings, and these massive hidden bank interconnections, the tone in Washington and global capitals has shifted entirely.
Yeah.
And the catalyst for that shift isn't just dry economic data, it's retail politics.
Yes, the politics of affluent retail wealth. Because mechanically, when a massive, faceless state pension fund takes a slight haircut on a 10-year illiquid investment, nobody really cares. The average voter doesn't feel it directly in their wallet, and it doesn't make the evening news. But when an affluent voter, someone with a vocal financial advisor, suddenly hits a 5% redemption gate on their retirement wealth and is told they cannot have their own money, politicians suddenly care immensely.
The democratization of access democratized the fragility. When affluent voters get angry, regulatory scrutiny follows instantly. We are seeing mainstream official concerns moving from the academic fringe directly to the center of policy debates. Regulators are looking at the architecture and asking a terrifying question. Did we actually disperse risk and make the system safer? Or did we just shift massive, interconnected leverage into a regulatory blind spot where we couldn't see the warning signs until it was too late?
And as we promised at the top of the show, we are navigating this debate entirely neutrally. Both of these realities absolutely coexist. Private credit undeniably kept capital flowing when banks retreated. It was economically useful and efficient. And simultaneously, it undeniably built a $2 trillion structure heavily reliant on opaque valuations and retail confidence, which is inherently fragile.
So the question for policymakers becomes, what are the actual solutions? If we don't just want to outlaw the asset class and crush middle market lending, how do regulators fix the cracks in the foundation?
Our sources point to a few key areas of mechanical reform. First, they don't necessarily need to outlaw anything, they just need to force transparency. We need better disclosure and standardized stress tests. If a fund is holding a 10-year illiquid loan to a software company, they need to stop pretending that investment is as smooth and stable as a cash-equivalent savings account.
That leads directly to the second solution: honest product design. The liquidity promises made to investors must mathematically match the actual liquidity of the underlying assets. You cannot safely market a vehicle full of private, illiquid loans as a quasi-cash alternative just because you offer a quarterly redemption window. The repeated 5% and 7% gates we saw activated in March 2026 are the market brutally reminding everyone that liquidity in these structures is conditional, not guaranteed. The product design needs to reflect that reality up front.
And third, regulators need a much more granular mapping of these bank-to-fund interconnections. They need to know exactly how much exposure the traditional banking system has to these private platforms through those subscription lines and warehouse facilities we discussed.
Because if those credit lines are the shock absorbers of the entire ecosystem, regulators need to mathematically understand exactly how much pressure those shock absorbers can take before they snap.
Okay, so synthesizing all of this for you, the listener, if you are watching your portfolio, or worrying about your company's credit line, or just trying to navigate the economy, what are the actual key metrics you should be watching? Ignore the talking heads on financial television. What does the data say we should watch?
First, watch the BDC discounts to NAV. Are they dropping below that 78 cents on the dollar average? If that discount widens to 60 or 50 cents across the board, it means the public market's distrust of the internal valuations is deepening into outright panic. Second, watch for repeat quarters of gated redemptions. One bad quarter of retail withdrawals can be managed with asset sales. If we see 2 or 3 consecutive quarters of oversubscribed redemption requests, the private wealth growth channel is fundamentally broken.
And third, Watch the watch list loans. Barron's noted that while formal 9 accrual rates, meaning loans that have actually defaulted and stopped paying interest, are currently relatively low, setting around 2.4%, the internal watch lists of loans showing signs of weakness are growing rapidly. Credit trouble always shows up on the quiet internal watch lists long before it hits the formal default numbers. And finally, watch how the big banks behave. If you see headlines about major banks cutting their warehouse facilities or demanding higher collateral from private funds, the liquidity squeeze becomes very real, very fast.
It is entirely about moving from an architecture based on blind trust to an architecture demanding verifiable proof.
Which brings us to the end of our journey today. Let's summarize exactly what we have unpacked. Private credit is not just a loan. It is a $2 trillion parallel financial system, a massive alternative architecture built from the regulatory ashes of the 2008 financial crisis.
It grew to massive scale on the promise of calm, steady yields and the myth of superior private governance, drawing in everyone from huge life insurers to individual retail investors hungry for yield.
But that illusion of calm was largely a byproduct of its unlisted structure. And now, a perfect storm driven by AI shocks to software collateral, wealthy retail investors panicking and hitting redemption gates, and the high interest rate environment is forcing the public markets to demand absolute mathematical proof that these underlying assets are actually worth what the billionaire alternative asset managers claim they are.
The market is fundamentally repricing the trust that built the entire industry.
Exactly. Which leaves me with one final, lingering thought for you to explore on your own. It's something that wasn't explicitly debated in the data, but mechanically it feels like the natural, inevitable conclusion of everything we've discussed today. If the only real solution to this current panic is forcing private credit to have more transparency, to enforce stricter liquidity rules, to map out their interconnections, and to submit to much tighter regulatory oversight,
Doesn't that mean the ultimate fate of private credit is simply to become the exact same, highly regulated, slower-moving banking system it was originally invented to escape?
and if it does, where does the risk go next? It's a fascinating cycle. When you build a massive, complex structure to handle financial stress, you inevitably discover new points of failure you never imagined. Keep questioning the headlines, keep looking at the mechanics happening underwater, and we will catch you on the next deep dive.